Lecture 8. Pair Trend Continuation Signals. In this lecture, you will learn about pair trend continuation signals. Through several examples, you will learn different types of continuation signals and how to identify and trade them successfully. Similar to the bull continuation signal, the bear trend continuation signal can also be either a strong bear trend bar in a bear spike or a reversal pattern near the end of a pullback. In this lecture, I will explain each type of this signal through different examples. In this 15-minute chart, the price was stuck in a trading range at the beginning of the trading day. Then it broke the range to the downside with a strong bear trend bar. Usually, a strong bear trend bar at the beginning of a trading day indicates a possibility to start a downtrend that could continue for some time during the day. As the day went on, the downtrend, as expected, continued for several hours and expressed by 4 legs down. Each attempt to break out to the upside failed, and a strong bear trend bars were every time a signal for downtrend continuation. Usually, when the day begins with such strong trend bar, it is expected for the trend to continue for 2 or 3 legs, and it is considered a good trading opportunity with low risk setup. The strong bear trend bars indicate that sellers have already shown their strength and that they are willing to sell aggressively on any pullback. On the other hand, bulls will step aside in such situation and they will not consider buying again until there is a good and very strong signal that the price is bottoming. This example is showing a downtrend that lasted for most of the day. It's worth noting that usually in downtrends, pair bars are large with short lower tails, typically similar to the ones that you can see here, while bull bars are usually small with long upper tails, and this clearly shows the aggressiveness of pairs and the hesitation of bulls. As the chart shows, there were many strong bear trend bars after every pullback, which were good selling opportunities for bear trend continuation. Remember that going with the trend is the safest way to trade the market, as I have said before, because most attempts to reverse an ongoing trend fail. Don't be trapped by the market and try to resist the temptation to go against the market. It might work sometimes when you try to catch a reversal at the very beginning, but most of the time the market will trick you that you might lose in one bad reversal failure more than what you have earned from many successful counter trend trades. The second type of pair trend continuation signal is the reversal patterns, and most of the time it is tricky for most traders because this reversal signal comes at the end of a pullback like this, where the market shows it's willing to reverse and to change the direction of the trend. And then all of a sudden, the strong sellers come back and flood the market with sell orders, sending the price down with another strong bear trend bar. Many traders are trapped by these pullbacks, especially when they are deep. However, trained, experienced sellers were waiting for these pullbacks to add to their short positions at a better price. Pullbacks happen, at least theoretically, because some sellers were taking profits and some buyers thought it is a good price to try to initiate scalping long trades at small portions to test the market. These two actions by sellers and buyers retrace the price higher in a pullback in one or more small legs. But how to trade pullbacks within a strong bear trend? And what if they are not pullbacks and they are just the beginning of a reversal? There are many rules that are helpful here, but the golden one is that most reversals fail. As you can see in this figure, the market showed many pullbacks trying to trick buyers and later trapping them, as it is seen by the long tails on these reversal patterns. Conservative sellers need to wait for the pullback to show the reversal pattern, confirming that sellers were back and that many trapped buyers to exit their long trades, adding to the pressure on the price to go down. Once such signal appeared, it is a good selling setup just below the reversal patterns, just here or here. Another consideration is that the market is rarely, very rarely, takes a steep turn around from one trend into another, unless of course there is an important news with a strong impact, like a sudden change of interest rate or something similar. But most of the time, let's say more than 90% of the time, the market goes in ranging before changing the current trend. Look at the price action here, where the downtrend lost momentum and transformed into a trading range. This would give you plenty of time to exit your trade with small profit or break even when there is no trend continuation. The number one killer for most traders that I have worked with is their urgency to catch a new trend from the very beginning, when history confirms that many failed attempts for breakout must happen before the real one occurs. This is the end of this lecture, and in the next lecture I will discuss two important signals, which are 2-bar and 3-bar reversal signals.